One of the things that we have stepped up is our communication plan. So many of you, I'm sure, have been reached on a one-on-one basis with Michelle and Stacy and the rest of the wealth management team. So having a lot of conversations in terms of the specifics and what this means for you and your portfolios. Second of all, we're doing the market calls like the one we have today throughout our footprint. So we're trying to touch more people and get as many questions answered as possible on a group basis. And then lastly, we've been producing regularly blogs. 4 were produced in March. Stacy did one in terms of long-term investment principles. I did one last week in terms of comparing the current downturn to prior bear markets and specifically what occurs in a recession. And then Ryan Decker in the Omaha team is working on one in terms of understanding the impact of the U.S. Coronavirus Aid, Relief, and Economic Security Act, or otherwise known as the CARE Act. So what does it mean from required minimum distributions and impact from a planning perspective? I did want to highlight just briefly a couple of those written research papers. The first is the long-term investment principles and the need or emphasis to stay invested in appropriate asset allocation. We do a lot of financial plans with individuals, but we also work just within the advisor plan in terms of what is the right level of risk and return goals, risk tolerance that you may have. So it's very important when you get into these volatile periods to be in that right long-term asset allocation. In essence, the reason is we don't believe in general in market timing. So if you look at it, you have to get 2 decisions right. First of all, you have to sell and the market goes down. Sometimes that's the easier decision based on the uncertain environment we're seeing. But the second decision is you have to know when to get back in. And history would tell you that individuals and professional investors, hedge funds, et cetera, don't get both of those decisions right on a consistent basis, because when you have to buy in is when the news flow is the absolute worst. So our approach is we'll talk about here in a little bit how we're doing things to minimize risk, be defensive in the current environment, but it's not an all-in or all-out type of approach, because over time that destroys value. That brings me to a couple points comparing this downturn to the prior bear market. So from the all-time high on February 19th to the low here on March 23rd, the average downturn was, we were very close to the average downturn in terms of the correction in the stock market. But what is important in the research piece is how long does it take you to recover to all-time highs? And in a recessionary environment, the average is 30 months. And a couple of points there is, first of all, we always go back to an all-time high. So selling now is, in essence, locking in losses. And then the fact of the matter is that it varies based on the severity and the length of the downturn, but we will get back to all-time highs. The U.S. economy and stock market is resilient, and we will recover from COVID-19. Turning a little bit to what's going on within the economy first, some pretty surprising, perhaps, or disappointing unemployment insurance claims that were announced today. They surged to 6.6 million during the week ended March 28th, which brings the 2-week total of unemployment claims to 9.9 million. If you put that in perspective, both weeks were above the all-time highs, so this is unprecedented in terms of the extent of the claims. And if you assume a stable labor force, so no growth or retirements, et cetera, so no decline in the labor force participation, this would equate to an unemployment rate somewhere around 9%. So based on the build up and the feeling that more is coming, so if you look at some of the states are still having issues in terms of responding to all of the inquiries and unemployment claims that are being filed. So there's still a backlog to work through, and the expectation is, although not necessarily at the $6.6 million level of unemployment claims, but they're still going to be high in the month of April. And to put that in perspective, it's now anticipated by most economists that we're going to exceed the level of unemployment that we experienced during the last recession and the financial crisis. So, obviously it's pretty negative. It's fairly widespread in terms of layoffs. No surprises here in terms of, hotels, restaurants, a lot of the service industry, including all automatic manufacturing plants in the U.S. Have been shut down. So, for our perspective, certainly anticipating a severe downturn. Couple things that are occurring from our government that are looking to cushion the downturn. First of all, the Federal Reserve has cut interest rates to zero and also announced a number of packages designed to alleviate some of the stress that's occurring in commercial paper, in mortgage-backed securities. And so some of the volatility you've seen in the stock market, you've also seen in some of the more illiquid areas of the fixed income market. It's been positive in terms of getting money and liquidity back into the market, so the Federal Reserve moves have been helpful from a fixed market perspective. Also, as you've seen, unemployment insurance has been increased, obviously very helpful with the news flow that I just outlined on unemployment claims, the check that's going to individuals and families at certain income levels, as well as the focus on small business lending, having capital through the Federal Reserve as well as through banking institutions. And that's one of the things that here at First National Bank that we're very involved with. There's a number of people getting involved in terms of helping clients go through the paperwork from a business standpoint. So all this is intended, and we certainly believe will help cushion the extent of the downturn. In terms of the length and ultimately what the recovery looks like, this is pretty unprecedented. Even though, as Michelle made me feel old by saying 30 years investment career, we haven't seen this type of a downturn or a virus impact here in the last 30 years from that perspective. On the positive side, there is reasons to expect the U.S. economy to be resilient. We'll come out of this more efficient than we are today. So we will get through this. Right now it's an unusual environment with almost 75% of people in the U.S. at a stay-at-home, but we will return to work and jobs will be created. So there's a lot of pent-up demand in some of those service industries that I've been speaking with. On the other hand, in our view, we were going into this with an extremely low unemployment rate of 3.5%, and our expectation is a lot of the jobs that are being lost will come back, but not all businesses will make it, and not all jobs will be, the rehiring will occur. So the unemployment rate, at least for a few years, is unlikely to get back to that extremely low levels. In terms of the strategy, what are we doing in portfolios? It's a very team-based approach. Michelle alluded to the asset allocation team that Stacy and I both participate, as well as other portfolio managers in Omaha and around the organization. We typically have met on a monthly basis, but we've moved that to weekly in the current environment to evaluate what's going on within the markets, as well as reviewing some of the economic indicators. I'm going to use an example. As I mentioned earlier, that long-term approach, staying invested, is a key investment principle that we've consistently written about. And we do invest with clients that are anywhere from conservative to moderate to aggressive, but I'm going to use kind of the middle of the road moderate example, which would be a 40 to 70% stock allocation range and a 20 to 50% fixed income allocation range. So where we're positioned, as I mentioned, we're a little bit more defensive. So if you look at our approach right now relative to the midpoints, which in that range would be 55% equities and 35% fixed income would be the midpoint in that moderate example. And we're underweight equities relative to that midpoint and overweight fixed income. In terms of what we've been implementing primarily in portfolios here, we have started to trim some of the fixed income part of the portfolio, selling out of a floating rate income fund, and I'll refer here in a couple of minutes. We've also been making some trades within individual taxable bonds. To date, we've been buying our hedged equity fund, so looking at the alternative investments that does provide some participation within the stock market, but also provide some downside protection. So at this point, we've been discussing, do we want to buy back equities? We have not done so to a large degree as of yet. We do see the potential that we've started the bottoming out process. If you look back historically, it's usually a 6 to 8 week period in which you find a level, you may retest that level, you bounce around with a lot of upward days, some downward days still. So we don't at all believe that we're past some of this volatility period. March 23rd was low, so it's possible that as we go through some of the negative news flow that we expect in April from the employment, as well as the escalation in COVID-19 cases, as well as deaths. So I still feel like we're in the middle of what's going on, but the stock market had corrected so much, as I mentioned, fairly close to the average downturn. So we continue to evaluate it, but at this point, we're more in protecting capital as compared to being opportunistic on an asset allocation basis. Where we are being opportunistic is if you look at our individual equity and individual bond strategies. So on the equity side, we have a number of individual stock strategy. They're holding their value fairly well. We take a quality approach to the investment styles that we manage. I would characterize it as we've seen more trading volume over the last month than the prior 2 months combined. And so it is an opportunity for us to buy securities that perhaps we didn't historically own because of valuation, but quality companies that we think will come out of this recession stronger than ever and taking market share. And so that's an example within the individual equity trades. We've also sold some companies that maybe don't have the financial strength that we're looking for in our strategies. Similarly, within our individual taxable bonds, treasuries have been the best place to be by far. The 10-year treasury yield, for example, earlier today was less than the 0.6% interest rate. So the range in treasury yields from 1 to 10 years is pretty much from 0 to a little over 0.5%. And so within our mutual funds as well as our individual bonds, we've seen some repositioning, some selling of treasuries as we look to add to companies as well as structured products that have seen higher spreads. And so there are opportunities in investment-grade corporate bonds, investment-grade mortgage-backed and asset-backed securities. So we've started to see some selling into that flight to safety that you've seen within the treasury markets. So in conclusion, we continue to meet frequently. All the teams are up and running. We're evaluating how to both protect portfolios, from deterioration, but also be opportunistic in terms of when we come out of this, to participate and take advantage when the recovery starts to occur from both a market and an economy perspective. So with that rambling overview, I'll turn it back over to you, Stacy. I don't know if you want to add a few comments and/or just get right into answering questions from people.
Yeah, thanks, Kurt. So again, we appreciate all of you being able to dial in today, and hopefully this is kind of one of the value-added services we can provide. We really want to make sure that what we're doing for investments on behalf of our clients is really tailored to each of your situations. So hopefully, as you're going through this time of volatility like the rest of us, you feel that First National Bank has a plan put in place to meet your particular goals and, are still on the right path. Definitely with any questions or concerns, feel free to reach out to any of your advisors or investment professionals to help and review that plan so you feel comfortable that we have a good understanding of where you want to go and what you need to do. So with that, we'll move over to some questions that we have. First question here, why are municipal bonds performing poorly? What are the risks that are out there in the municipal market?
Yeah, so what you've seen is, the asset classes that have less liquidity have sold off maybe the most. So if you look at the municipal bond market, whether it's in Nebraska or the national muni market, in general, it's not the most liquid from that standpoint. And so what you've seen is people have cashed out of their equity and fixed income holdings. That's put some pressure in terms of the fixed income part of the portfolio. You know, there is some concern about credit risk as a result. You know, municipalities will be impacted in terms of the revenues that they're generating if there's, you know, significantly less sales taxes. Perhaps down the road, even real estate taxes, although that's pretty tenuous. And so, you know, there's maybe some concerns. So the other aspect of that is the liquidity, but I would say that anything with credit, you know, concerns. When we look at the municipal bond market, first of all, we see it as more of a buying opportunity. So you get these credit scares, you know, periodically in the market, whether it's Puerto Rico or Chicago or some of these areas that don't have the credit quality of the bonds that we're putting in, and eventually the municipal bond market settles down and you go back to normalized spread conditions. So this spike isn't, you know, we see this every few years, and we're in one now, and from our perspective, it's time to take advantage of it. The other aspect is when we're buying municipal bonds, to start with, we focus on essential revenue bonds, utilities, housing, education bonds, because we know people will want to continue to invest in that areas of their local communities and local economies. And so our focus is always take a high quality approach, and, you know, you get these, you know, sometimes the negative. I would say that the municipal bond markets came back strongly. So early March, they were down about 5% in March, and they recouped most of those losses by the end of the period. And so you've already started, as I mentioned, with the Federal Reserve information, you've already started to see more normalcy come back into the credit markets.
All right, next question we have is, will equities paying dividends continue to pay out, or do you see some companies scaling back or potentially stopping their dividend payments?
Yeah, I think you've started to see some announcements, especially in areas of the marketplace that are under the most pressure. So you have seen, to date, it's been more you know, dividend stopping the increases kind of thing. And then in certain industries like energy, for example, because of oil prices being under pressure, not only from the demand shortfall, but as well as what's going on with Saudi Arabia and Russia in terms of increased supply in the marketplace. I think you're going to see some stoppage of dividends as well. So the dividend flow, you know, I think will be somewhat negative, similar to what it was during the 2008-2009 timeframe as companies, you know, try to figure out what they're doing. But we do think that they'll restart. So once you get past, you know, the health crisis and the economy starts to get back to work, then businesses can evaluate where are they from a cash flow, from a debt standpoint. So I think it's more likely to be a temporary slowdown. Even if some companies in the S&P 500 do, you know, stop or reduce, the dividend yields you're getting from equity income strategies are going to well exceed what you can get in U.S. Treasuries. And so the yield for an equity income strategy is around 3%, and even if you get maybe a 20% reduction in dividends, and that's just a guess, you're still talking about yields at the 2.5% level. Well above the 0.5% that you can get in the government market. So dividends will be a source of income. But yeah, you know, it'll be company by company, industry by industry, but some stoppages temporarily. Companies really hate to do that. So what you've seen probably more so is stopping your share buyback plan. So even some of those energy companies, the big integrated companies have talked about, well, we won't buy back shares, but we're kind of maintaining our dividend for now. So certainly they understand that the income that some people own stocks, especially in equity strategies for dividends, and so they management knows that and they try not to cut, but temporarily you may see some reductions.
All right. Next question we have is, do you feel the government and Federal Reserve have done enough with the stimulus packages that have currently been passed, or do you think that more will need to be done?
The crystal ball question. I would say that there's probably likely a little bit more to be done from, I think it's more likely to come from the federal government, Congress, et cetera, because, you know, it was pretty widespread, the CARES stimulus, I guess it's not a stimulus package, but the deal that was reached from that perspective. But it'll be a little bit more targeted going forward. I mean, who is really hurting businesses, individuals, et cetera. So maybe, you know, I don't, you know, anticipate necessarily another $2 trillion deal. And I don't know if I said this earlier or not, but to put that in perspective, that's about 9 to 10% of our economy and well above the packages that were produced following the financial crisis. So it's already a large amount. But just the severity of the unemployment leads me to think that there'll be some potential phase 4 and some targeting going on.
All right. Next question. For accounts that have used indexed equity ETFs, how do you execute your leaning towards quality and protecting against more volatile companies and sectors?
You know, that's maybe the slight negative with an ETF strategy is you buy the market or you buy whatever index that and an ETF is an exchange-traded fund is invested in. And I think we've seen that impact on the market during this downturn is because ETFs represent now a half of the investment management universe, and as well as a lot of the institutional hedge funds utilize that to go long or short portfolios. And so you've seen the trading activity really dominated by that index and ETF funds. And to a certain extent, you know, there's not a way, you know, to focus more on those high quality. So my comments are we have index approaches within our mutual fund models. We use them in institutions. A lot of times I would say that how we utilize ETFs is as part of a hybrid approach. So we'll have some active management in addition to those ETFs. And that allows us to tilt portfolios in certain industries or sectors as well as towards those high quality companies that we believe will provide portfolio protection. So we're more of an active manager. A lot of our strategies, the core and satellite approach, the multi-cap, the equity income that we just talked about, are individual stock strategies that allows us to do that balance sheet work, you know, return on capital, and position portfolios based on our economic and market outlook. So a pure index approach is you have an index and you go up and down, you know, based on how they're trading and how other institutional investors are implementing their portfolio changes.
Thanks, Kurt. How does this economic downturn the same or different from the financial crisis of 2008 and 2009?
Yeah, I would say it's a fair amount different. If you go back to the financial crisis, it was relating to the housing and the housing bubble, banking and other financial institutions that were lending into the mortgage markets were under a lot of pressure, and that led to a pretty severe downturn. I also think the recovery, if you look at globally, countries that have gone through financial crises, they always have a weaker recovery period, and so the 2% or so economic growth over the last 10 to 11 years, in part, shouldn't be a surprise if you look at it from the standpoint that economic recoveries following the financial crisis are always weak. And the reason, quite frankly, is that financial institutions, if they're in the process of recapitalizing, they don't have as much money to lend to individuals as well as businesses, and that puts a cap on growth. This one, so I see it as different. It's completely different sector. So we haven't had a services recession, and now we're having one. So as I mentioned, it is the restaurants and the hotels and the travel and the cruise ships and all of the consumption, type indicators. So it's hitting a different level, and why that's maybe important is that's where a lot of people are employed. And so even though some of those service industries aren't in aggregate a big percentage of our economy, they are a big percentage of the employment picture. And a lot of those individuals are living paycheck to paycheck or don't have that type of thing or type of cushion from a financial standpoint. And so it's hitting in different ways. The positive, even though it's going to hit employment harder, is I think the recovery will be stronger. So I'm not here to tell you that it's a V-shaped recovery, a sharp downturn, and a sharp recovery, but certainly the recovery will be stronger as a result of that. Part of that is banks are in much better financial condition. So the U.S. especially recapitalized. First National Bank has more capital than they've ever had. So we can be more supportive and are supporting our communities and businesses, from that perspective. So you'll see, I think a sharper recovery once we get past the stay-at-home policies. So I think to me, I guess it's quite a bit different. This is, a real big shock, but once you get past this, I think, that will be in better shape. So I guess the last thing, debt perspective, individuals have a little less leverage than they did 10 or 11 years ago. Banks have, more capital or less leverage. Corporations, I think that's the risk part. So some companies had leveraged up to buy back shares, increase dividends, invest in their businesses. And so that's maybe a bigger concern as well this time around is the extent of debt within the corporate areas.
All right, next question we have is in regards to, will this recession have an impact on some of the medical kind of educational programs that are out there to assist individuals that are currently in place?
I guess I'm not quite sure what they're looking for. Can you repeat that again, Stacy? Or
yeah, so just a question for someone. Yeah. The government has various programs for help, like with student loan packages, maybe assistance with medical insurance. Mm-hmm. Do you see any impact of this relationship or this recession to any of those type of programs?
Yeah, I think it's too early to tell, but I guess my opinion would be is that, things are going to change, here as we come out of this. So we're not going to go back to where we were a couple of months ago, and that does include the potential for changes in medical education, and I'm not referring to, short-term forbearance on, student loans or, on medical standpoints. So I think it will be an opportunity for us as individuals as well as the governments to see what kind of changes would be made. So I definitely don't believe it's going to be back to the way it is. And as I mentioned earlier, though, it may cause us to come out of this more efficient in certain areas from that standpoint. Order online and pick up at the curb, has appealed to me now, and I think it'll have appeal to me, for example, on the retail side 6 months from now from that perspective. So that's an area that you can see. So it's something that our equity teams maybe are a little more versed in answering what they're hearing about. I think it's a little too early to tell, as I mentioned, but that's part of our team-based approach in terms of evaluating what is changed, whether it's a federal program, on medical or on education, and then positioning companies that benefit that will come out of this stronger and be in the right or make changes to their business model to take advantage of what's going on.
What are First National Bank's thoughts on gold as buying gold or part of a hedge in a portfolio?
Yeah, it's something that we talk about now. And the reason why I kind of chuckled a little bit is I've been kind of known on the investment team as the gold hater, but I'm kind of the ones thinking that maybe now is the right time to own a little bit of gold. So it's not part of our current alternatives allocation. We have, as a hedged equity fund, we're also looking at, I'd call it more of an opportunistic credit type fund to take advantage of the dislocations in the credit markets, and gold's another possibility. One of the reasons why I think gold maybe has more appeal now than typical is, as you've seen, governments pushing interest rates down to zero, or obviously in parts of the world to negative interest rates. They're not valuing their own currency, or whether it's the dollar, the euro, the yen, the renminbi, kind of standpoint, the pound from UK. So as long as governments aren't valuing their own currency, that leads you to look at, is there other alternatives from cash that's earning zero or potentially even negative in parts of the world. And we don't expect negative interest rates in the U.S. Actually, I believe they're a huge mistake when Europe and Japan went down that approach. And so hopefully the Federal Reserve says, there's stimulus from zero or close to zero interest rates, but not from negative interest rates. So I think a small allocation could have a portfolio. We don't have one today, is the answer, but it is part of our ongoing weekly conversations within the asset allocation team in terms of that. And I think in this environment where interest rates are zero, that's where it has more appeal. It's less so an inflation hedge, like it's perceived to be, and it's more, do you have confidence in the government and ultimately the economy and where interest rates are today and where they're going. But it could provide some protection if we recover and we're still running a big deficit and inflation becomes a concern. So it's more governments aren't valuing their own currency, and as a result of what they're doing with interest rates, and they want to, in essence, borrow at low interest rates to fund the deficits.
Given the recent increase in unemployment claims, do you think there'll be any delays in the rehire process once we come out the other side of some of these kind of shelter-in-place orders?
Yeah, I don't know if it'll be delayed because of the size of it. I think it's businesses would like to reopen. Can they hire back from that standpoint? And so it'll be, I think it'll be very interesting to watch because, if you are hoping as a business to hire back most of your same employees, it depends on if you're earlier in that process or they found other jobs by the time you take that approach in terms of the hiring package. So I think it takes some time. I mean, it's not like you can turn around and hire your entire staff back all at once, from that standpoint. So I don't know if it's a delay necessarily, except for it'll take a few weeks or months for businesses to rehire to get back to what their version of a full staff is.
Are there any particular sectors that you think look appealing at this time, given some of the dramatic pullbacks?
I guess the one thing is with all of our individual equity strategies, we're not really sector rotators. So more of the trades and what we're trying to do is add value or alpha by owning the right companies. So it's more of a bottom-up quality approach. Look for companies that have the revenue or earnings growth, or will resume revenue and earnings growth when the economy restarts, and then what's the valuation. So that valuation discipline is extremely important to our process. So if you look at the trading activity over the last month, as I mentioned, it's, for example, in our equity income strategy yesterday, we were selling out of entirely one bank stock, but we were buying three other financial institutions or banks within that strategy. We are also, so that's what I mean by more intra-industry. I would say, we have been maybe certainly not buying into the really more heavily cyclical areas. So not like in your industrials, your energy, your basic materials, more of the buy-in activity. Technology has been an area that we've been doing some buy-in. Healthcare is another area, depending on the strategy that we've been buying. So kind of a combination of defensive and technology in general has a lot of companies with net cash positions or low levels of debt. So they can withstand the downturn and should come back strongly. So I would say, kind of consistent with when we talk about the severity of the downturn is we have not been bottom fishing into your really cyclical areas yet. The economy, it's something that, we own industrial stocks, we own energy stocks, we own financial companies. And so I guess our approach is not so much at all sector rotating, but making sure that we own the right companies, even if it's an industry or a sector that's under pressure.
All right. Well, I have one last question that I'm pretty sure we've done these calls across a variety of parts of our markets. I think this is the fourth or fifth one that Kurt has done, and I'm sure this one hasn't come up. But as an Iowa State grad, what do you think the chances that Fred Hoiberg can get the Huskers back on the right track and beat the Blue Jays?
I don't know if I can answer that. I'm still bitter, about the whole situation. So I'll give you, my lukewarm, non-response responses. Well, someday it'll happen because I think he will succeed at Nebraska, but it may take him a little while to get the players he needs to resume. And I just hope that we're watching basketball for the entire winter and March Madness returns in March because as a big sports fan, I'm missing sports right now. I don't want to continue to watch CNBC all the time from home. So he'll get it done, but maybe not for a while.
All right. Well, I think everyone can appreciate the fact that everyone would like to get back to a little bit of new normal, and whether that includes sports or going out to movies or going out to dinner. I think while it may be a little bit more time before we're ready to do that, I think everyone's looking forward to it. So, again, I want to thank everyone for calling in and participating in this. We had a lot of good questions submitted. We do appreciate that interaction. And, again, as I said, if there's anything that maybe we didn't touch on today that you didn't have a chance to submit a question, feel free to reach out to someone on your First National Bank Wealth Management team. We'd be more than happy to set up a time to have further discussions, review kind of your financial plan, goals, and objectives. But just know that we're here as a resource for you during these difficult times. And thank you very much for calling in.
Stay safe, everyone, and thank you.